Do you own this book? Option Volatility and Pricing, Sheldon Natenberg, strategist at CTC. Or maybe this one, The Options Edge by yours truly and Professor Mark Guthner of Rutgers. If you don't, we're going to go over some important topics from these today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, strategist at YieldMax ETFs, contributor on CNBC, co-author of The Options Edge. This book right here, Option Volatility and Pricing by Sheldon Natenberg, is one of the books that I've recommended to people who are trying to familiarize themselves with options theory and options concepts. If you want to trade options, do you need to have this book? Do you need to have read it? No, you don't. But there are some important concepts that I think it's really critical to understand. In this particular book, what I'm going to be talking about, and I've talked about them before, but I need to do it again, we're going to be talking a little bit about synthetic positions. So that's chapter 11, beginning on page 213 of the version that I happen to have here, which I've had a long time, so I'm sure there's been others that have been put into print. I don't know when this one was published, 94 it looks like. So if you happen to have the same version, it's chapter 11 in here, and you can learn about synthetics there. And if you find this topic interesting, by all means, pick up one of these books and dig into it. In our book, we talk about synthetics, actually about the same period. But I'm really going to be talking about replicating stock, replicating calls and puts. That is about page 240 in our book. It is chapter 9. So that begins on page, oh, you can't make that out. That begins on page 235. You can find out. Now, the important point about this is that it speaks to a couple really important concepts. Extrinsic value and where that derives. And also, it helps you understand the strategies where options are being used. So, this question came up because a journalist from Seeking Alpha had reached out to me and was asking me about an options income overlay ETF that uses synthetics. Now, a lot of options income overlay ETFs do use synthetics because ETFs are 40 Act funds and they have to navigate certain rules, including RIC concentration rules, Registered Investment Company concentration rules. The most common of these concentration rules, and the ones that are probably going to matter most, are something called 25, 5, and 50. And what those rules stipulate is that one of these funds may not have more than 25% of its assets in a single security, with the exception of Treasury securities, and that's important. So I'm going to just pull up my screen here, and we're going to take a look at one. In fact, we're going to look at the one that I was being asked about, which is AMDY. AMDY is the AMD, which I'm sure you're familiar with, AMD, the corporation and the ticker, the AMD Options Income Strategy. And because this is a strategy that only has one underlying stock, it presents a problem when you think about the Registered Investment Company rules and the concentration. So in this particular instance, the fund has, see how much, I should know this offhand, but we'll just double check. So the fund's got $360 million in it. And if you were going to simply buy the stock, then you would have to buy, let's see where AMD closed. So you would need to own 452.40 is where the stock closed. So you've got $360 million in your fund. And that would work out to 795,756 shares of stock. But of course, you can't buy $360 million worth of stock because you would be violating the 25% rule. That means that you can't have more than 25% of the $360 million or $90 million in the underlying stock. And even if you did that, you would be maxed out effectively. So what can you do using options to replicate an equity position and not run afoul of this rule? You can trade something called a combo or a synthetic long stock position. What is that? Well, I'll illustrate it. So we'll use options play in this case for this. So if you look at the panes over here on the right-hand side, this is a stock position, right? So you can buy 100 shares and you get a payoff that looks like this. Everybody is familiar with the payoff. If it goes up 1%, you make 1%. It goes down 1%, you lose 1%. Pretty easy, pretty straightforward. Okay. If I bought a call option, that is obviously not the exact same payoff, right? Because a call option has defined risk. Essentially, I am risking the amount that I spent. That's the extrinsic premium. And I'm risking however much the stock is in the money if the strike is below the current stock price. But I can construct a synthetic position by saying, okay, well, if I bought the 450 call, that's the at-the-money call, what if I then simultaneously sold the 450 put? And now look what you have. So this chart looks remarkably similar to this one. Now here's the thing. Does it matter that I chose the 450 strike versus the 400s or the 500s? And the answer is no, not really. So it will have a small impact on the amount of premium spent or collected, because if you look at this trade right now, I don't know if you can make this out, but I'm going to highlight this premium section over here. You'll notice that in this particular instance, you would be paying $63.55 to buy the August 450 call, and you would be collecting $57.60 to sell the 450 put. And we can actually put these two together, right? So if I take 63.55 and I deduct 57.60, that works out to $5.95. Okay. Now, what is the functional equivalent that I have paid for this stock? So we're going to do a little bit of, this is not hard math, it's a little bit of arithmetic required. So if I'm long the 450 call, that gives me, the holder of the call, the right, but not the obligation, to buy AMD at $450 a share. So if AMD is above 450 as of August expiration, I'll buy it for $450. Now, contrarily, if I am short the put, that means that I have the obligation to purchase the stock at $450 if the holder of the put option exercises their option and I am therefore assigned. So if it goes up, I will exercise my call and I will buy the stock for $450 a share. If it goes down below the strike, it is in the put holder's best interest to exercise it, which means I'm assigned. As the assignee, I am obligated to purchase the shares at $450. So in either case, whether the stock goes higher or it goes lower, I will, when August expiration comes along in this scenario, buy the underlying shares for $450. Now, you will notice that I also had to spend a little bit of money to get into this position. $63.55 less the $57.60. $5.95. So did I actually buy the stock at $450? No, I actually spent $450 plus the $5.95 to get into the options position. So I spent $455 and 95 cents to put on this position. Okay. Now, if you're wondering to yourself, well, why would the synthetic have you buy the stock at a price that is higher than or greater than The current price of the stock, which if you look over here, I will circle it, is 452.40. So why would I ever engage in this position? Right? I can buy the stock right now for 452.40, and if I buy this forward, effectively, that's synthetically what I've constructed, I'm paying 455.95, which is $3.55 higher than just simply buying the stock outright. Well, if I buy the stock outright, I have to post all the cash to do that. On the other hand, if I buy this forward and I have, I don't know, the same amount of money held up in a risk-free asset, money market account, a short-term treasury bill, something like this, then I have the same amount of capital committed, but the treasury bill or my my money market account is going to pay me some interest. So I'm actually going to get some interest. How much interest? Well, an interest in this particular case, because I'd have to have it supported by $45,000 worth of stock. Each contract represents 100 shares for that number of days. So we can actually do a little bit of math there too. So 72 divided by 360, 365, whatever you want to use as your mechanism for calculating, the portion of a year. So we could say, all right, well then I'm going to get 1/5 of a year's worth of interest on $450. So $450, let's just say the interest rate is, 3%, and I'm going to get 1/5 of that. That works out to $2.70. All right, so I was just using a 3% interest rate. So $2.7 in interest is what I'm going to be getting back. So did I really spend $455.95? No, I spent $455.95, but I also got $270 back. So now I'm actually spending $453.25, which is much closer to the $452.40. Now, the reason synthetic positions are so important in the world of options is because options traders recognize that they can, with some combination of options and treasuries and stock, they can replicate other positions. And when you can replicate a position, that means you can also identify arbitrage opportunities. So for example, if this was trading for even, so if the 450 call and the 450 put were both trading for $60, so I could buy the call for 60 and sell the put for 60, that means I would effectively own the stock at 450 in the future. And I'd get to hold as collateral to do this treasuries. And if the stock is 452.5, which is about where it closed, I would be very happy to purchase the synthetic, collect my interest, own the stock in the future at 450, and sell the stock today at 452.40. So in this way, there has to be a relationship. And actually, I see a comment here. Alex, the interest will be immediately taxable. So I have to stop you there, Alex, because Alex, you are thinking about this like a retail market participant. Number one, there are people who are not in taxable situations. So for example, public trusts, pensions, endowments, things like that aren't subject to tax. So you cannot make assumptions about how securities will be priced based on your unique tax considerations. So there are market participants who are not taxed. The other thing is that as a market participant on the dealer side, I am only going to be taxed on my effective net profits, net of all the transactions. The interest is not treated separately. So no disrespect. Everybody needs to consult a tax advisor, and you need to think about that, but that's not applicable here. Yeah, everybody has their own tax consequences, but when it comes to creating an arbitrage-free environment, that's not going to play into it very much. Now, one of the places that you're going to see where it does play in is in something like municipals versus treasuries, because you have, local debt, which may have certain tax advantages, and it would create an arbitrage opportunity on the tax portion. So you will see prices not related to each other on the basis of those willing, able market participants unique to X considerations. So that is to say that there should, in an efficient market, and the market is not completely efficient, but there should, in an efficient market, be a circumstance where people will pay more for a tax-free investment than they would for a comparable one that is taxable. But bear in mind that those market participants who do not necessarily have a realizable tax advantage in one circumstance for another will not actually be market participants in that case. So I hope that also helps. Okay. So one of the things you're going to observe here, and I'm going to just keep this example, and I'm actually going to take this down. So I'm going to get down to, let's say, the 300 strike here, and now I'm going to create the exact same trade over here, August, except I'm going to say, this is going to be a put now, and this is going to be the 600 call. Okay. So now we have, you could buy the stock, you get this payoff. And that looks very, very similar to buying the 400 strike call and selling, or 300, that's right, I adjusted these strikes. Buying the 300 call, selling the 300 put, and that payoff looks remarkably similar to buying the 600 call and selling the 600 put. And what you're going to find is that if you are pricing this in the market, the difference in the price of this synthetic here, down here, this one, and the price of this synthetic over here is going to be related to the interest expense or interest received. So if I buy a 300 synthetic, where the 300 strike call is $150 in the money, then I'm going to own less treasuries, right? So the amount of interest I'm going to collect will be substantially less. Consequently, I would expect this relationship to exhibit a lower price than the 600s. Let's take a look, right? So if I buy the 300s, this is actually, the problem we have here is that the bid-ask spread might be fairly wide. So we're going to do this live, and I don't actually know how this is going to turn out, but then I'm going to explain what the math should be, even if it's not true in this particular instance. So 163.30 to buy that call at the midpoint, collecting 810 means that I'm going to actually be laying out $155.20 to buy this synthetic. Now, if I lay out $155.20 in premium to buy this synthetic, then I'm not going to be able to buy as many treasury securities in this hypothetical construction that I've worked out for us, right? So in theory, the interest I would get in this scenario is about a third less. And if we take a look at this and we add it to the strike, now I'm getting not the $455.95 I had before, but now I'm getting $455, and what did I just have? $163.30 and $810. Now I'm getting $455.20, 75 cents less. And if we go to this other synthetic, this is just using the mid-market prices, but I'm going to actually explain to you how you know whether that's a fair price or not, which is all very important as well. I look at the 600 calls. Now I'm going to spend $21.05 to buy the 600s. I'm going to collect $164.43 by selling those puts. That means I'm actually going to collect $143.38. So in this construction, I still have the same P&L, very similar risk-reward relationship, right? It's just going to trade like stock. But the amount of money that I actually had to put out is going to be less. In fact, it's actually a credit because I will have spent a small amount to buy that upside call, and I would have collected a lot of money by selling that put. And now I can actually do all of that math. So 21.05 plus, 164.43 minus, and then 600 plus. And now the purchase price forward is 456.62. So it is higher. And this makes sense. Why? Because otherwise there would be an arbitrage. That arbitrage would be that in one case I'm laying out more premium and therefore not collecting the interest. And in another instance, I'm going to be net collecting premium. The risk-reward relationship of the underlying trade is the same. The difference is what we call the cost of carry. So now that we've seen that the cost of carry is dependent on the strike, the cost of carry is a benefit, essentially, in this particular case, if you're buying the combo, buying the call and selling the put, you can actually figure out that, assuming there's no dividends, and let's just assume that these options were all European, it just keeps the math a little bit easier. What you can see is that you could even buy this synthetic and sell this one, right? So I could get long the 600 synthetic and short the 300 synthetic of the same expiration, and now I have no exposure to the stock, right? That trade is called a box, and it is purely a cost of carry trade. If I buy the 300 calls and sell the 600 calls, and I sell the 300 puts and buy the 600 puts, I have bought the box. I've laid out all the premium. I have no directional exposure to the underlying asset. And I should expect, if I buy that box, to spend less than the distance between the strikes, less than 300. Why? Because otherwise there would be an arbitrage. The person who sold it to me would be able to sell it, collect the money, put it into treasuries, have no market risk. Again, this comes down to the whole concept of replication. And the idea of replication is critical for understanding how options are priced relative to one another. Other examples of synthetics that we could do. I could, for example, let's just go back to our 400 call or 450 call that we had here before. I've got a 450 call. All right, so there's our call option. Now, what happens if I take my stock position? All right, so that was with we're looking at August, I think. August 450 call. So I've got stock. If I add a 450 put to this, what do you think happens? So I add the 450 put, and lo and behold, I have essentially the same thing. The August 450 call is synthetically equivalent to the August 450 put plus stock. But if I buy the August 450 put and I buy the stock, I have an outlay of $50,700. If I simply buy the call, I have an outlay of $6,300. Because I could own treasuries for the difference, this price has to reflect that difference, right? Because I'm going to be able to collect the interest. That otherwise, I would have an arbitrage. And I can construct a synthetic call, long or short, with the stock and a put. I can construct a synthetic put, long or short, with a call and a position in the stock. I can construct synthetic bonds of a sort. And that's actually, I've mentioned that in the past, why we traded boxes in SPX. Traded a lot of them when I was at Cantor Fitzgerald, for example, because if I ended up net long premium, I had to post all that. So even though my directional risk might be small, my premium outlay might be large. So I would sell premium and try to get that back to even and not tie up a huge amount of the firm's capital to do it. We would typically trade 500,000-point boxes at a clip. Now, a 1,000-point box is $100,000. 500 a clip. So we basically would trade 50 million in premium at a go. Because obviously, we didn't bother to do things if it was, $500,000 or $1 million this way or that. But, we would try to keep it, trued up so that we were pretty much flat premium. And this is really important because I think folks need to understand these relationships. It helps you when you are trying to price out different ways to do the same trade. But the important thing is that the most important thing to understand, I think, is that you can replicate just the underlying asset with an option. If you are long a call and short a put of the same expiration and the same strike, and we're going to assume for simplicity that they're European, meaning that they cannot be exercised early, so you will not be assigned before expiration, and you will not have the choice to exercise your long option before expiration, then you essentially have a synthetic position in the underlying asset. You will not collect the dividend, so once again, the price of the options has to reflect not only the interest you would collect on the cash balance that you get to maintain by having the synthetic, but it also has to reflect the dividends that you will not get because you don't own the stock. And that's essentially how these things get traded. When that happens, these types of trades go on in the options market making world all the time. It gets quoted all day, every day, in big size. You can make bets exclusively on dividends doing this kind of stuff. In fact, you can actually just trade dividend swaps as well, but now we're getting a little far afield of the whole thing. If you ever hear somebody talk about RevCons, that's an abbreviation. Rev stands for reversal, con stands for conversion, and those are the opposite sides of the same trade. And that is when people make a market in the synthetic versus the common. If I reverse, that means I bought the synthetic and I sold the common. And if I convert, that means I bought the common and I sold the synthetic. Trades all the time. In fact, it was oftentimes the very first trade we would do when we started to make a market in an option, is we'd convert. And the reason we would convert is because you didn't want to get caught up in a situation where if a stock went hard to borrow, you couldn't get a locate. You couldn't borrow the shares. And there was another reason, which is that when I first got started in the business, there were more restrictions on how even market makers were permitted to sell a stock short if you were, even if it was easy to locate, even if it was GC, as we say. We had a situation where we had to hit plus ticks and 0 plus ticks on the listed names, meaning New York Stock Exchange listed issues. Now, some of these rules have been relaxed a little bit to make making markets easier and more liquid and more fairly priced. But that was another reason why we typically wanted to be converted. That in a bad situation, gun to your head, if you could own the stock or be stuck in a synthetic position, you'd rather own the common. So anyway, this is an important concept. And if anybody has any more questions on it, I'm happy to answer them. If there are other forms of synthetics that are of interest to you, I'm happy to answer those questions as well. But if you want to learn more about it, we wrote about it. Shelley Natenberg wrote about it. Options Market, which is a book by who did that one? I think that was Cox and Rubenstein, who also have a model named after them. They talk about synthetics, I'm quite sure. There's another book, Futures, Options, and Other Derivatives. I'm sure, it would have been a huge hole, and I've read these books, so I'm trying to remember where it would be in it, and I'm trying to picture it in my head. I don't remember it exactly, but I'm sure they cover it as well. But really, really helpful to have these things firmly in mind. Because I have had people, and sometimes recently, come to me and say, well, what if I did this? What if I did that? What if I owned the stock and I sold a call that was in the money, and then I sold a put that was in the money against it? That, by the way, is called a gut strangle. And they're wondering what their positions would look like. And Madoff, for example, Madoff did not know what synthetics were. And he used to tell people that I buy stocks. I buy good, high-quality stocks that pay dividends. Okay, sounds like a reasonable strategy. And then to generate some extra income, I sell calls, covered calls. Okay, we've heard of that. And then I will buy puts to protect it. Okay. And somebody said, not for nothing, Bernie, but isn't that a conversion? if you buy the stock and then you sell the call and you buy the put, isn't that just converting? Remember what I just explained converting was? And Bernie apparently responded by saying, oh, no, but I don't use the same strike. I'm not doing them at the money. I split the strikes. So it's a split strike conversion. So look that up. Bernie Madoff referred to that as a split strike conversion. But the funny part is that if you had spoken to an options trader, you'd say, no, that's not a split strike conversion. Because a split strike conversion is a made-up thing. You have collared stock. You also have a synthetic call spread. Those are the same. An in-the-money call spread and a collared stock position are the same thing. It is also a put spread. Don't believe me? I will show you. So, we are going to have a long stock position, and we are going to sell an out-of-the-money call, and then we're going to buy, and we are going to buy a protective put. And what the heck, we'll do it like this. So there you go. This is what Bernie, in his complete lack of wisdom or understanding about options, called a split strike conversion. No such animal. I mean, I suppose you can call something whatever you want. You could say it's a blocky figurine. I don't really care what you call it. But that is a collared stock position. And it is also synthetically the exact same thing as a 430, a long 430, 470 call spread. And that is the exact same thing as, we got to switch these both to puts, a short 470, 430 put spread. So what was Bernie doing that was so tricky, so fancy, this split strike conversion as he called it? And the only reason he came up with the idea to call it a split strike conversion was because somebody knew just enough to question him when he said, oh, I buy stock, sell call, buy put. And then somebody was like, wait a minute, converting, I mean, how much money could you make doing that? Because you're long the stock and short the stock synthetically. That doesn't sound like that could be all that profitable. You get paid the dividends, but you lose the interest, so probably not a whole lot of money in that. Certainly not the whatever he was claiming he was making, 17 to 18% a year. He never put that trade in front of somebody who knew what they were talking about. Because had he done it, they would have called him out immediately. And actually, that brings me to an interesting story. I don't think my friend is going to mind me telling this story, so I'm going to share it. Dennis David is a friend of mine. Dennis David is the former head of derivatives at Credit Suisse. He and I have served on panels together. He has done some stuff on CNBC as well. He runs a money management firm that's based in North Carolina. I think it's Millbank, Dartmoor, Portsmouth, I think is the name of it. MDP, name of his firm. But obviously he was the head of derivatives at Credit Suisse. He was also a partner at Wolverine, which competed with Bluefin and Gateway, other market-making firms I was a part of. Anyway, I believe Dennis went to Davos one year, and he was at a bar, and Bernie Madoff was, down the bar from him. And if Dennis sees this, or if I get this wrong, I will happily correct it in a future video. But my understanding was that, there were rumors that Bernie Madoff was generating these spectacular returns, very consistent, almost metronomic returns, just consistently generate. And it just wouldn't have made any sense to people who traded a lot of options. And so, Dennis went over and said, was wanting to talk to you a little bit about your strategy. And Bernie made the comment to him, just said, he gruffly said, you wouldn't understand it, and walked away. Which is kind of an interesting thing to say to an engineer, one of the biggest derivatives traders in the world, who, by the way, when Bernie Madoff was being asked about how come he often reported having positions in options that didn't have any volume or any open interest, which would seem strange, he then claimed that he was trading these things OTC. OTC means over the counter. Now, we traded some OTC derivatives, variance swaps. Those were over the counter. But the interesting thing is, it would have been very hard to trade OTC derivatives in size at the time without ever having interacted with someone like Dennis, because he probably would have been on the other side. Because OTC derivatives, you have to have an ISDA. So that's going to be big banks, stuff like that. Anyway, thought it is important to understand these things. You won't fall for Madoff, will you? Because you will know immediately when somebody brings that same old song and dance up and says, hey, I've got a quick and easy way to make guaranteed steady money, you will know that it's nonsense, because you will understand synthetics. All right, FinWest. Good morning. I see FedEx had a corporate restructuring. What do you think? Should I stick with FedEx for trading, or should I now consider FDXF, which is their freight stub spinoff, separate stock, or both, or neither? Thanks for your insight. So let's pull this one up first. Unfortunately, so in a case like this, and I really would have to go through all of the financials to really understand how the business is being completely broken apart. One of the challenges for me here is that I can see how this is valued, because that's easy enough. The current market capitalization is the shares outstanding times the share price. Easy enough. And, of course, oh, I'm showing options play. I must have not shared. I shared a window, not my monitor. Sorry about that. Hang on a second. Let me correct that very quickly. So, share, screen, share. So now you should see FDXF, I hope. Right? Okay. So, I'm hoping I was sharing all the last stuff I was doing in Options Play as well. Not just talking, but actually, okay. All right, so again, market capitalization, easy enough. It's the share count times the share price, so we can tell what that is. This, now when the company has a corporate action and they spin off a business, of course, one of the things they have to do is some pro forma calculations, so that even if you're dealing with units that were previously combined, when you were bringing a new security to market, you still need to have some financial information available, as they have here. So effectively what we're saying is, for the period ended May 25, 8.887 million, or 8.9 billion, give or take, in revenue would have been attributable to what we now know of as FDXF, even though this has only been around for a handful of trading days. And if we look here, so we can get a sense of what this was, kind of. Now, if you've been watching these live streams for any length of time, you will also know that, taking advice from me regarding FedEx, which has just been the bane of my existence. I've had 2 disastrous instances with positions in FedEx. Many, many years ago. I'm not going to say that the auto hedger went amok, but let's just say the auto hedger did something that had not been contemplated against an iceberg vol-quoted order. So what I mean by that was, we had a huge block of FedEx calls that we were trying to sell. We were trying to piece it out. And so I was using a quote engine to push a dynamic price on those call options in odd lots, in small pieces. So it might show 50, and then if someone bought 50, I'd sell 50, and then it would auto-refresh. Well, somebody must have figured out that there was that was the tip of the iceberg. And in fact, you sometimes call those iceberg orders. So as the stock price would move up, my call offer would move up, and as it moved down, it would move down. It would just float dynamically on an adjusted basis because I was quoting in vol space. And then as calls sold, the auto hedger would see that my delta is adjusted and just go into the marketplace and buy some stock. Now, I had a lot of positions at the time. Maybe it was almost 150 individual underlying stock positions. And so I had a lot of things to keep an eye on. And I remember I looked over and all of a sudden I saw FedEx tick up and then come back in. And I remember thinking, boy, that's odd. I wonder what happened there. And then the very next thought was, boy, I hope that wasn't me that just traded that. And sure enough, someone had swept all the calls. The auto hedger just went and did his thing, and it fired in a huge order at the market. $140,000 down the tubes in seconds. And of course, the specialist on the big board printed FedEx just inside the obvious error rule, so I couldn't bust the trade. So that was one instance. Another instance that was a complete nightmare was several years ago. We had a position in FedEx, and the stock disappointed right here. So this move was a quarterly earnings release, and that proved to be the worst one-day post-earnings move that had taken place in FedEx in 3 decades. And of course, we had a position in it. We had a position in a lot of things, but that was another day. In fact, what was interesting about that was that we ended up imposing a concentration. We remember I was talking about Rick rule concentration limits, why people trade synthetics, because you can't have all the stock and so on. Just for our funds, we also said, because we did not initiate our position in that one. By the way, this has nothing to do with Yield Max. It was a different actively managed ETF I was involved with at the time. But we did not have an excess concentration to FedEx, but our exposure to FedEx had grown through that period because our FedEx position had appreciated, sort of see here, ahead of time. So we actually owned it. I think it's actually basically this period right here. So we had a nice gain in the stock. And we hadn't sold off, let your winners run, this and that, whatever. And we typically would hold stocks through earnings. We didn't sell stocks in earnings, quite the opposite. And so we got this big disastrous thing. And that position had gotten, it was actually our largest single holding. Nowhere near 25% or anything like that. But it had become our largest holding simply by virtue of the fact that the stock had grown. And I, in consultation with some of my colleagues, said, you know what? Not enough of this. I don't ever want to see one stock take the entire portfolio down by, 2% almost, which is what it did. So we said, that's it. It gets to a certain level, and we're going to start taking some of our profits. Okay. So I don't really have that much insight to offer on FedEx yet. I will say the following, and that is that I think we can go through the same process that we do for everything else. Because I can't break down the freight and logistics side, I don't really have a good barometer to use to gauge what I think the estimated revenue growth will be, to gauge what the free cash flow will be, to gauge the margins that they have and the close comps and whether those are expanding. It's just I don't have enough history. I don't have enough data to make an informed choice on that. I'm sure there are people who understand it a heck of a lot better than I do. I'm sure that every person who covers the stock, every person on this list right here, David Vernon at Bernstein and Ravi Shankar at Morgan and Jordan Alliger over at Goldman, I'm sure that their working knowledge of this dynamic is stronger than my own because they know all these components intimately. Here's what I would suggest to you. Go listen to the most recent earnings call and to any conference calls they've had since, particularly as they pertain to this corporate action, and hear the questions that the analysts are asking management. What that will tell you is when they build a model, which is a job I also had. So you build a spreadsheet and you're trying to model a company, is that you have to have a couple sort of critical variables that you're trying to guess at, and from that divine some reasonable valuation for the business. And when you listen to the questions that the analysts ask management, what they're trying to do is hone in on what each of those numbers are. So by keeping track of all of those questions, you know what the drivers are as far as the sell side is concerned to the value of that underlying business, to that equity, to that security. And then you can build your own and go back and say, okay, well, maybe I differ on this number and differ on that one, but you get a sense of the things that are going to matter. The other thing is you could say, well, what if I don't think they do matter? What if I think it's something completely different than that? I have a completely different metric than they use. That's fine. But you ignore the ones that they care about at your peril. Why? Because the street tends to look at all these things the same way. So if you ever notice that a number comes out, it disappoints, and the stock sells off, that means that everybody kind of universally came to the same conclusion. It's because they're all looking at it the same way. And that's a strength, it's a weakness, but it is also a reality. What is the best way to identify sector rotation? A relative rotation graph, probably. Like this. This is a good way to do it. So this is called a relative rotation graph. And what it shows is in the middle, right in here, this is versus the S&P, right? So the S&P 500. So if you see over here, infotech, information technology, IT, technology stocks have, if it's over here, this means that they are outperforming and that outperformance is accelerating, right? And we didn't need to pull up an RRG for you to know that, right? I mean, everybody's been watching it. So that is really helpful. You can also see that energy has been falling, right? Now, if you're looking at this and you're saying, okay, a relative rotation graph, I've never seen one of these, how do I read it? Well, consider this. If I live down here in this lower left quadrant, what that means is that this is a lagging industry. It's underperforming the rest of the market. And if you're looking for future outperformance, what you're really trying to do is handicap. Like, I don't need to sit here and say, oh, Infotech is all the way up here in the upper right-hand quadrant. You know that already. The key is actually to identify those underperforming sectors which are starting to round the bend. Financials, it looks like they had a little bit of a false start. You can see these little arrows. I don't know if you can make this out. I'm going to try to blow that up, or maybe the producer can as well. No, yeah, the producer has to do it, because when I try to blow that up, it doesn't blow up. It just does something weird. Okay. So if you can't quite make it out, what you're going to see here is that there are these little arrows. So this is where we are now. And so you can actually go back and you can see that financials looked like they were starting to climb out of the doghouse. But then it kind of turned this way and went this way. Consumer discretionary, you can see consumer discretionary started to go this way, started to come up, but now look, it's just dipped back a little bit on a relative basis. Energy, this is kind of a hard one, because the reason that energy went completely nuts, and this is, we're only looking at a relatively short period of time, but we had what's going on in the Middle East, and that's going to be its own kettle of fish, so to speak. But really what you're looking for are things that are in these areas right here, this lower left quadrant, that are starting to get a little bit of a relative, they start to turn and go this way. And hopefully you identify it long before they ever get here, right? I'm not helping anybody by telling them looking at this graph and saying information technologies outperform. Everybody wants to see what the rotation is. Okay, what's next? I look at this chart and I would say that this looks to me like staples they're just starting to turn. That's what you want to see. Healthcare, just starting to turn. Actually, you know what? I'm glad you brought this up. Why? Because I suggested taking a look at Cigna, cnbc.com/options-action. I write articles there periodically. I wrote one recently on Cigna. Cigna has, like much in healthcare, not done particularly well. You guys have heard me speak about Humana and United Health and other managed care companies in the past. This is the part that I think is kind of interesting. So this is a 5-year price chart. You can see it's basically been dead money for most of that period, at least on a price basis. And if we look at this, one of the things that might be of interest to you is to say, okay, well, is that because the company hasn't been performing well? It's not. So there were some, as many will know in the managed care space, there were some missteps in many instances on reimbursement rates and other nonsense. But this is the revenue picture over the course of the last 5 years. And you can see that revenues have gone up quite a lot. And this now is the forward price to earnings ratio. Again, over the last 5 years. So you can see this is crude, but revenues in white, see, just going to make it a little bold, revenues up sharply. And price to earnings, although it's kind of lumpy, whipping this way and that, is generally lower. So revenues going up, but the multiple is coming down. And this is, look where we are. We're at 9.3 times forward earnings. Compare and contrast that with the same chart for the S&P more generally. So we can look at the S&P, and we can look at revenues, and sure enough, they've been going up, not quite as significantly, but a lot. So this has revenue growth, very solid revenue growth. We love the revenue growth, but it's not as strong as the revenue growth that Cigna has seen. And if we take a look at that same forward PE ratio, we know that the S&P prices have been doing well. Very different situation, right? So we had 9.3 times, and this is significantly higher than it was in 22, and healthcare was significantly lower. So going back to Cigna really quickly, what do the technicals have to say? Because I just showed you a long-term chart that didn't look particularly compelling. Well, the best performing technical indicator here, which is the moving average envelopes, and would have been up almost 91% in the last year, is actually bullish here. Okay, so that sounds good. But Bollinger Bands and trading envelopes are both negative. And these other ones are all positive. So I look at this and I say, well, moving average envelopes, Bollinger Bands and trading envelopes, aren't those kind of the same thing? Why is one bullish and the other two bearish? So I go to moving average envelopes and we take a look at how this behaves. And you will observe that whatever the trend it is, it creates these bands. And when you're in the outside of these bands to the downside, it covers shorts and goes long. And when it's out of them to the upside, it covers longs and goes short. And so consequently, you would have sold here. You would have bought down here. Sold, bought, sold, bought, sold, bought, sold, bought, sold, bought. Okay. So that looks like a good trading indicator. I'm going to ask you, looking at this chart, after what I just told you, this is still long, but if anything, remember when we were talking about Vlad Furman's system with Dom, the options trade AI guy, that we were talking about exhaustion. This is the trend, but it does look like it's closer to where you would probably initiate a sell than to where you would probably initiate a buy. So my thinking is, given that this also pays a decent dividend, and actually, in some ways, given it's a healthcare company, I thought that the implied volatility was actually kind of surprising, sitting around 30. I was thinking, sell the July 280 puts. Get a decent rate of return. Have it put to you. And if it is put to you, which is what you want, then just start selling some calls against it. And then also, start getting some dividends as well. Next, it goes ex-dividend first week of September, by the way, so you would not be getting dividends ahead of time. But, you know, by my work, you should be able to get 12% annualized out of this thing without too much difficulty. And I just don't see a huge amount of risk in owning it at 9 times. So, yeah. And we were just talking about the relative rotation. So you were asking about that. That's here. I mean, has it actually started to do this? That's what we want. This is the ones you want to own, especially as they start trekking into this neighborhood. And hopefully you time it right, and you end up buying that green line before it turned green. You're going to get it down here. I don't know. I will let you also be the judge. But to me, I'm looking. Okay, this is the healthcare one. If you're not making it out, I'm going to draw it. It's doing this, it's doing this, it's doing this. And now we're here. Next week we're here. And the next week we're here. That looks like a little bit of a button hook. And that's the button hook you want, right? You don't want the button hook going this way. You want the button hook going that way. So am I early? I could be. That's what my eye sees. And relative rotation graph. I don't know where else you can get them, but I'm sure they're available. Finn West. Sorry to bring up bad memories on FedEx. No, look. We learn more from our bad trades than our good ones. You do a good trade, and it's very easy to say, you see how clever I am? I've got this licked. I figured it out. I know how this works. The market, what makes people better are those moments of humility. And hopefully they aren't so damaging that you aren't able to take the good lessons that you learned and put them to use elsewhere. I have a saying, and I used to apply it to everybody that I ever hired to work with me or for me on a trading desk. And that comment was, you will cost me a Harvard Business School's worth of tuition before you're ever worth a damn. Which is another way of saying, I knew they were going to screw up. I knew it. They will always screw up. And it is only once they screw up that now they're going to be worth something. Because that mistake won't happen. And also, it teaches them how to think about things a little bit differently. And it's interesting because this is another story, and I'm not going to share the name, but I had a clerk on the New York Mercantile Exchange, and he made some mistakes. It was not only his mistake. There were some other clerks that participated in the mistake. But we used hand signals down there. And he was trying to learn the hand signals, and so outside of one of the pits, he was practicing the hand signals. Practicing hand signals on a real trading floor? Now, of course, on that trading floor, you had to be a member of the exchange to trade, in theory. But in practice, it's definitely true that clerks, assistants, and signal clerks as well would relay orders. And because sometimes your back was to the pit where you wanted to execute an order, maybe I would instruct a clerk in front of me to do something, and he would instruct a signal clerk behind me, and that person would signal a broker in the neighboring pit to effect a trade. In any case, I'm looking at a signal clerk, and he does this, looks at me and does that, which means you're done. I hadn't put an order in. What do you mean I'm done? Done. Sold 20. I'm like, whoa. I was trading natural gas at the time. So natural gas has a 10,000 multiplier, which means that whatever the price change in natural gas is, I am now short that 200,000 times. So if it goes down 10 cents, that's $20,000 I just made. And if it goes up 10 cents, I just lost 20 grand. I'm confused. I actually leave my spot, go over what's going on. And he says, yeah, your clerk gave us an order to sell 20 Feb futures. And I said, well, he certainly should not have done that if he did. And I called him over. I won't share his name. And I said, did you instruct this guy to sell 20 futures? And he's kind of looking confused and perplexed. And he says, I don't think so. And I was like, how is this possible? How could you not think so? I mean, you either did or you didn't. Did you tell him to sell 20 futures or didn't you? And then he tells me, well, I was practicing my hand signals, and I might have made a hand signal that looked a little bit like sell 20 Fib. It's like, oh my God. All right, so immediately bought the 20 contracts back. The reason I mentioned a dime is because lost about 20,000 bucks on that one error. Whole thing was resolved in about 7 minutes, right? Probably less than 7. And there was one other error that the same person had made. And, he was very apologetic about it. I was like, these things happen. And I was thinking to myself about the mistakes that newer people make and how once they make them, they're probably not going to make the same mistake again. Anyway, that clerk resigned about 4 weeks later. And I was speaking to one of my other clerks. I said, why did he resign? He said he thought you were going to fire him. I said, if I was going to fire him, I would have fired him. Like, what would I be waiting for? I said, he's only worth something to me now because he's made that mistake. He won't make that mistake again. So I was like, well, that's just great. And how could he not think that if I was going to fire him, that I was going to what? Wait until Memorial Day? I mean, it's ridiculous. If I was going to fire him, I'd fire him. Anyway, about 2 months later, I hear a whole bunch of screaming in a neighboring pit. And it's another trader. And he is yelling at that very same clerk. Apparently, he had made a huge mistake for him. And he was saying, you just cost me a car, and not some cheap car, a really nice car. You just cost me a 7 Series BMW or something like that. And I could hear all this yelling. And I was thinking, I guess sometimes the mistakes, you really do have to either make a lot of them, or maybe he just wasn't going to learn. I don't know. I dodged that bullet. Got away with a $20,000 loss. But yeah. Okay, so Donovan, you got your relative rotation. Yeah, so FinWest, it's not a hiring philosophy necessarily. It was just an observation. And it was remarkable. It was absolutely remarkable how many times I experienced the same damn thing. That you would hire somebody really smart, maybe didn't seem that smart. I mean, it didn't really seem to matter. Had a trading assistant when I was at Cantor, good enough guy, went to Yale, hardworking, but sure enough, he made a really dumb mistake. Was not the same mistake that this other guy made, but it just, and it's probably true for me too. In fact, it is true. When I was green, when I was new, when I first started trading options and I was on the floor, there were mistakes that I never made again. And they were costly when I made them. And I didn't get fired when I made them. And in at least one case, knowing what I learned from that lesson helped me have the most profitable trading day of my entire career about 9 months later. Same stock, similar circumstances, and completely changed how I handled that day. And it paid, I don't know, made 10x maybe what I had lost in a single day. So it's the mistakes that we want to put them out of our memory, but those are the things we actually have to remember. Because if you remember your successes, then you just think that you walk on water. None of us do. At least I know I don't. So, and I don't look all that good on water skis either. I look like a uncoordinated cow, probably getting dragged around on a water ski, which is one of the reasons I'll never do that anymore. Anyway, so this has been a little bit different than the normal video would be, but I hope that you found this helpful. The synthetics portion in particular, do that math from time to time on your own, and you'll really find it very helpful to just look at put-call parity, look at where the synthetics are trading, and just think about the dynamics. Whenever you see, And this is also one of the reasons why calls and puts to market makers are defined more by how far they are from the current stock price higher. Every strike higher than the current stock price, options traders tend to think of those as calls, and everything that's lower, they think of it as puts, whether it's a call or a put, because once you start hedging it synthetically, that's what it becomes. You're long the strike, short the strike. The only time you really start worrying about whether it's a call or a put and whether you're in a synthetic or not is if the stock pins. And you're left with a choice to make about whether you exercise your longs because you don't know if you're going to get assigned on your shorts. But that's a topic for another day. So thank you very much for your questions, your comments, and if you have more of them, put them into the comment section, and join us here next week, 4:15 on Monday. Thank you so very much for watching.